portfolio. But till a year ago, basically 60% of our portfolio was invested in Indian equities, 30% was global equities, and 10% was fixed deposits. It reduced the weightage of Indian small caps quite considerably, and we shifted that to the global piece. Western small and mid caps are 5, 10, $15 billion market caps. I still continue to be a very active user of NPS. If you diversify across multiple assets with low correlation, your returns will be the higher of the two assets, whereas your volatility will only be the mathematical average. The correlation between these two markets, USA and India, is the lowest pairwise correlation between any two large markets. You increase the odds in your favor, right. You're choosing from a broader basket of high quality companies. Yeah. Because 8% underlying inflation means every 9 years, your cost of living will double. Yeah. And you can understand why I worry about the Indian middle class intensely. Household debt for the Indian middle class is amongst the highest in the world.
Welcome to the latest episode of Guru Portfolios, where we quiz leaders, investment managers, and ace investors about their own investment journeys. In today's episode, we have with us someone who manages assets of about Rs 5,000 crore, Saurabh Mukherjea, founder and CIO of Marcellus Investment Managers. Hi Saurabh, welcome to the latest episode of Guru Portfolios. It's great to have you here.
Thank you for inviting me.
So Saurabh, we'll get straight into it. We would like to know how your asset allocation has changed over the past year as well as over the last 5 years.
Sure. So look, the last 12 months have been, I think, from my personal asset allocation perspective, probably the most momentous months for me, right? So till a year ago, as has been the case for the preceding 17 years, for till a year ago, the majority of my portfolio was invested in Indian equities. Courtesy the years that my wife and I spent in the UK, we had a UK pension plan, and we had a small investment in Marcellus's global compounders portfolio. But till a year ago, basically 60% of our portfolio was invested in Indian equities, 30% was global equities, and 10% was fixed deposits, the safe harbor that I've highlighted in all the previous Guru portfolios, right? But the events of the past year have led to a significant shift in our asset allocation, right? I'll start with the most dramatic one. Roughly after the general elections last year, we realized that the economy was softening, right? And both in Marcellus's small and mid cap portfolios, we started going into cash, and we progressively increased the cash because we felt that the economy is softening, small and mid cap valuations are very rich. And we felt that a hefty move into cash was warranted there. And for my part, in my personal portfolio, I reduced the weightage of Indian small caps quite considerably, and we shifted that to the global piece, right? So we increased the Marcellus global compounders over the course of F25. Marcellus's global compounders went from being rather being 20-30%, went to being closer to 40% of my portfolio. Primarily at the expense of investing in Indian small caps, right? We made a more modest reduction in my large cap allocation to India, but that was more modest. It was more around the fact that some of our large cap holdings in CCP, my large cap investments in India, largely in CCP, consistent compounders, some of them are done very well, and hence we reduce the weightage. But the large cap weightage is still pretty high. CCP and Indian large cap equities is 40% of my portfolio. Indian small caps, which is primarily Marcellus Little Champs, is now just 10% of my portfolio. And global investing, global compounders plus my pension in the UK is now 40%. So for the first time in the 17 years I've lived in India, the attractiveness of small and mid cap valuations in the Western world versus the richness of Indian valuations has meant that global equities and Indian equities are roughly the same weight. In my portfolio. Thankfully, even today, if I add up Indian large cap and small cap, it's still 50%. Whereas global equities is still 40%. But I think the attraction of the global piece is that companies which for 40-50 years have been compounding earnings at 15% in dollar terms are available in Europe, in America, in East Asia at 13 times, 14 times earnings. And that's just too attractive a carrot for folks like me. And to see this shift in valuation, India has become far more richly valued than small and mid caps in the Western world. And remember, Western small and mid caps, Josh.
Yeah.
Western small and mid caps are 5, 10, $15 billion market caps. So these are big companies whose products you and I are using every day. In fact, for this very session, the lithography on the electronic equipment we are using, the lithography comes from a Marcellus investee company in Eindhoven, Holland, which is a globally dominant player, right? So that's the main shift. Cash remains 10%. Consistent compounded out, the Indian large cap piece remains 40%. Within Indian large caps, I also have my NPS allocation. I still continue to be a very active user of NPS. So the Indian large cap piece primarily CCP, but has a reasonable amount of NPS as well. But the big change was increasing the global allocation sharply as through the year. Courtesy Mr. Trump, our valuations became more attractive. I kept swinging more money, and I think we discussed this in the interview last year, right? I told you that the instinctive thing that people do is wherever they say returns, they could run towards it. And what I've learned to do over the last few years is when others are running away, I go towards that. So I think global small caps is something others have run away from, and I have sort of over allocated there in the hope that it'll bear out for me in the coming years.
Okay. And can you give us a flavor of how the mix has changed over the last 5 years?
See, I don't do any gold, so nor do I do any bonds. So for me, equities has always been 90%.
Okay.
And cash has been that 10%. So it's always been 90-10.
Okay.
Just that 5 years ago, global equities was only 20% of the portfolio. Now global equities is 40%.
Okay.
And that's largely, as I said, at the expense of Indian small caps, which have gone from being 20% of the portfolio to 10%.
Right.
Indian large caps 5 years ago, by 5 years ago, we're looking at basically the world post-COVID. Post-COVID, if I look back to April, May 2020, Indian large caps were mouth-wateringly attractive, and hence large caps were 50% of our portfolio then, but they're still 40% of our portfolio. So if you had to look at the big change, small cap weight has dropped from 20 to 10, and the global weight has jumped up from 20% 5 years ago to 40%. I think increasingly you will see this in India. Courtesy Gift City, courtesy improvements in technology where most Indians now have easy access to brokerage apps which allow them to invest around the world. Everybody has a $250,000 LRS quota that they can use each year. I think global diversification will become a predominant theme in Indian investing over the next decade. It makes no sense to invest in one country. If you can diversify across other countries, especially other countries who have delivered over 10, 20 years like the United States has, and other countries who have low correlation with India. So Harry Markowitz famously got the Nobel Prize for pointing out that if you diversify across multiple assets with low correlation, your returns will be the higher of the two assets, whereas your volatility will only be the mathematical average.
Right.
So your risk-adjusted return will improve sharply. So just to put this in the Indian-American context, over the last 20 years, America has delivered around 13% dollar returns. India has done around 10. The correlation between these two markets, USA and India, is the lowest pairwise correlation between any two large markets. So evoking Harry Markowitz here, if you do a 50-50 India-America allocation and say you rebalance each year, let's say you rebalance on 1st January, just to keep it simple. You rebalance 1st January every year. What Markowitz's Nobel Prize winning finding was that even though America is 13 and India is 10, if you do 50-50 rebalance every year, your returns will be higher than 13, but your volatility will be the mathematical average. In retrospect, it's a mind-blowing finding. Because the human instinct to say if America is 13 and India is 10 and I do 50-50, so I will get 11.5. Right? But Markowitz said, no, boss, you won't get 11.5, you won't get 11.5. You get the higher return because each year when you rebalance, you'll buy more of the cheaper market and you'll take out money from the more expensive market, right? And that's the power of rebalancing across asset classes with low correlation. Right? If you do that with highly correlated asset classes, say multiple small cap funds, फिर आपको ये फायदा नहीं मिलेगा. You have to do it with asset classes with low correlation, and I've tried to do it, and I'm still trying to do it. Right? America is cheap. Right? When do you diversify into another low correlation asset class? When that asset class is cheap. Right? When do you diversify out of an asset class? When that asset class is expensive. Right? So India, to my mind, is relatively expensive today. America is relatively cheap, and therefore I'm toggling from India to America.
And Saurabh, in India, we still have a lot of investors who are home biased. And you here have like about 40% of your portfolio in global equities. What would you say to them, and why you think it is important, and why investors should be more globally diversified, and also how it has helped you to achieve your own goals?
Yeah. So look, I will let me focus on the second point first, right? How has it helped me achieve my own goals? So if I take a year like F23. I think that was perhaps the first year you guys did the survey with me. Maybe it was F22. So in F23, my Indian investments did really badly, right? So for that year was a particularly bad year ending March 23. was a particularly bad year for Marcellus' style of high quality investing. And on average, in our domestic portfolios, we were down 12-13%. Had all my money been in India, I would have also been down 12-13%. But thankfully, even then, I had a decent allocation to global equities. And as a result, I ended the year not down 12-13, I was down 4%. Right. So by diversifying into another geography, global compounders, which did well that year, then that year my global portfolio delivered 20-21%. And it buffered me from the hit back home, right? High quality Indian stocks did badly that year. I would have been hit badly had I not diversified into high quality global stocks, right? I'm not going to compromise on quality. Wherever I invest, I want to invest in clean, well-run companies. It's difficult for me to buy companies which are low quality, even if they look optically cheap. So if I want to buffer my downside, I need to diversify globally. Similarly, if I take a ulta example, right? If I was completely invested in global stocks, then the blockbuster rally that we enjoyed in FY21 in India, I would have missed out on that. So I grew up abroad. So as I boss, I grew up abroad. Let me be biased to the world I grew up in. Let me just invest over there. India, to poor country. I want. If I said stuff like that, then the blockbuster post-COVID rally that Marcellus enjoyed, where our small cap fund was up 90% in a year, CCP was up 55% in a year, I would have missed out on that, right? So by diversifying globally, you're buffering your returns, you're smoothing them out. And if I look back at my 5-year average, right, my 5-year average return across good years and bad years, bumper years post-COVID, tough year F23, decent year last year, decent year in spite of challenges in the Indian small cap, mid cap market, I still made 7% last year. If I look back at the highs and the lows, I'm averaging 18% CAGR over 5 years. And that suggests to me that this works. I would ideally like to average 20%, but I need to realize that the global economy has seen a downshift. India itself has seen a downshift after the elections. And therefore, if I stay calm, stay diversified, keep looking for high quality compounding opportunities at reasonable valuations, wherever they may be available in the world, I'll do better. Another way to sort of convey the diversification point is, suppose I chose the Indian cricket team only in Andheri. And I said, I'll only pick players from Andheri to play for India.
Andheri Indians.
Andheri Indians, yeah.
Okay.
Right, and I said that's my bias, right? We'll have a few good players, I'm sure. Andheri is colossal, especially if we take Andheri East and West, it's colossal. So we'll have a few good players, right? Some of them might be from Marcellus itself.
Yeah.
But by spreading my net wider, by saying, well, I'm happy to go to Borivali, perhaps Bombay, and if I'm going to Bombay, why not actually take talent from across India? By spreading the net wider, I'm creating greater chances of a better, higher performing team. I think the same is true with investing.
Right.
If I said I'll only invest in North Indian companies, right? I think everybody reading this or watching this will laugh, right? Why will you just do North Indian companies? What's wrong with you? So I'll say I'll invest in Indian companies. But similarly, someone with a global perspective will laugh and say, why will you just do Indian companies? There are great companies in all parts of the world. Take a global perspective. Since technology has now made it easy to research companies across the world, Indian brokerage has made it easy to trade online with companies across the world. And Gift City has made it easy for Indian fund managers to build global portfolios. Why not take advantage of that? And just like a pan-India team is better than a cricket team only made of players from Andheri, a global portfolio will do better than a portfolio just of...
You increase the odds in your...
You increase the odds in your favor.
Right.
You're choosing from a broader basket of high-quality companies.
And you also spoke about NPS. What has prompted you to stick with NPS?
So from the time Marcellus first, even from my preceding job, I was an NPS investor.
From your previous employer?
From a previous employer, and 3 things appeal to me, right? Firstly, you get tax relief on your entire investment. Secondly, whatever you invest, your employer tops up, and both on your investment and the employer top up, you get relief. And thirdly, the fees that the NPS fund managers charge are lower even than index fund fees.
Right.
NPS means, for those who are unaware, NPS means the equity investments are all tracker funds.
Yeah, actually.
They're all tracker funds. But over long periods of time, if the tracker funds have very low fees,
Yeah.
you get a decent outcome out of it.
Yeah.
Plus, I'm getting tax relief. Plus, my employer, Marcellus, is putting a top up.
Okay.
Plus, the other added attractions, I can't break the money. And if suppose I felt tempted, ki, well, let me now buy a holiday home in Goa.
Right.
Let me break my NPS and buy a holiday home in Goa. Those sorts of temptations are out of the way because I can't crack it open. It's not easy to crack open the NPS.
Okay.
So that gives you the coffee can wala discipline.
Right.
Coffee can wala discipline. Coffee can ka whole logic, Rob Kirby ka logic tha when he did this 30 years ago was put high quality investments in a tin or a coffee can and lock it up and let it be for 20 years and you'll get rich.
Right.
So in a way, MPS is a real coffee can, right? You're putting the index, low cost index inside a tin, which is hard to touch, and you're letting it run. You're getting tax relief and the employer is also contributing.
Right. And what about your own financial goals, Saurabh? I think last time we met, you were planning for your children's education
So
goals.
at children's education, the clock is started ticking. We've started paying fees for various colleges in the Western world.
Okay, so they are going abroad.
Sort of looks like. I mean, the deal is not yet done. We're still contemplating whether go abroad in the Trumpian world, whether going abroad makes sense or should he stay study in India. So our son we've reached judgment day with our son, and then 2 years hence it'll be judgment day with our daughter.
Okay.
So those monies we have set aside.
Okay. He is going abroad.
We still, so there's an Indian possibility still in the picture, right? So we have to use time. I think we have another 2 months.
Okay.
And we have to make the decision whether he goes abroad or he stays in India.
Okay.
And if he goes abroad, which country? So we have another 2 months to make the call.
Right.
And then we have 2 years with our daughter to make the call. We'll see how, and ultimately we'll leave it to them, right? Our job has been to save money, invest money, make it available to them. Do the best that we can for them. Ultimately, they have to make their life decisions. And then uske baad, as I've said for the last 3 years, simple goal, 20 crore retirement corpus in today's money.
Right. Yeah.
Which, given how high inflation is for people like us,
right,
given the cost of this lovely camera being used to shoot the podcast, given the cost of the electronics.
But right now the inflation is at 6-year low. And
but as I've said last year as well, right?
Yeah.
Don't look at CPI inflation. It has very little to do with your and my life. CPI inflation mein food ka weightage is very high.
Correct. Yeah.
I think 30 or 40%. I doubt for anybody watching this podcast or reading the Guru portfolio, 30 to 40% of the budget goes on food. For most people in our startup society, I would submit to you, inflation is 8%, right? Which means roughly every 10 years, cost of living doubles for them, right? In fact, a little less than that, every 9 years, cost of living doubles. Therefore, if I've got 20 years to go to retirement, which I hope I have, whatever money I need, it'll at least double. So if I need a 20 crore retirement pot in today's money, 15 to 20 years hence, we're looking at a 50 crore pot. And I know it makes people sort of go, wow, how can that be? But that's basic mathematics for you, that 8% inflation, 20 crore retirement pot in today's money, which is I think, decent sum of money to live a 25, 30-year retirement. I hope to be able to write books and do useful stuff in that retirement. But inflation is the killer here, because that's through 20 crore pot, when I retire 15, 20 years hence, will have to be 50 crore then to deal with us zamane ka cost of living
and whatever your retirement lifestyle you want to pursue then to meet all that.
And the way I did the maths was I took roughly what we spend at the moment. And I said the bachas will be out there on their own. So my wife and I need a certain sum of money, a certain annual expenditure. Usko lane ke liye for 25 years. And the math suggested to me we needed 20 crores. Now, if somebody says, look, I can be perfectly happy in retirement with 20 lakhs a year, just for assumption that they can be, then I think then in today's money, they could be able to do with a retirement pot of say 5 to 7 crores. But even for them, assume that the number is 5 crores in today's money, even for them, assuming 8% inflation and assuming that the retirement is 20 years out, 10 years में 5 crore का 10 crore हो जाएगा, 20 साल में 10 crore का 20 crore हो जाएगा, because 8% underlying inflation means every 9 years your cost of living will double. Right. So even for someone who just plans to have a 20 lakh wala retirement, and 20 lakhs gross. ठीक है. Net मतलब 15 lakh.
Correct.
Net 15 lakh का retirement, I think roughly a 5 crore pot is what's required in today's money. Which in 20 years hence ka money is more like a 20 crore pot. And if that person is 30 years from retirement, you can see what I'm going to say.
Yeah.
And I don't want to say it.
You can leave that to imagination.
Right? My God, right?
Yeah.
So the time value of money is enormous.
Yeah.
And you can understand why I worry about the Indian middle class
Sure.
intensely.
Right. Yeah. So actually, coming to that point, you have been vocal recently, and we'll come back to investments. A few questions I had, but since you touched upon middle class, why you think middle class is in a crisis right now?
So what we are seeing, right, in both our investment activities and in our personal lives, that industry which was staple sources of employment for the middle class, IT services, for example, banking, another example, media, another example, right? These were staple sources of employment for people in our startup society. They would study hard, get into decent colleges, emerge with a decent degree, and at the age of 21, 22, get an entry level job in an IT firm or a bank or a media organization. Technology clearly is eating those jobs away. And if somebody who's watching this or reads your article says nahi ho raha hai, I would love to hear from them, because I see technology eating those jobs away. I can see that in my own family. And your newspaper also contains plenty of stories about prominent firms either laying off young people or not hiring any new young people. In fact, if you look at the annual reports of the Nifty companies, right, India's mightiest companies, 10-year growth in headcount is some 2% or something pathetic like that, right? So as AI becomes more and more powerful, I think the displacement of young Indian graduates with AI will be very punchy. And you can see that last 2 years, the graduate recruitment, the graduate unemployment numbers are getting pretty worrisome. Not only that, even in middle management, I'm seeing people in my social circle losing jobs, because in middle management as well, AI is replacing human being, right? So just to take this example, perhaps your firm already uses AI to edit interviews. So if AI is being used to edit interviews, initially I'm sure it'll be a co-pilot type setup. जहाँ पे AI will be the co-pilot, there will be a human editor. But my reading is in due course, publishing houses, media houses will say, यार co-pilot इतना advanced हो गया है. Remember, this is generative AI, so the co-pilot will get cleverer and cleverer and cleverer.
Right.
That the need for editors will reduce, and hence media houses of the future will probably stop taking young journalists in their 20s, right? So that's the world that I can see, and you can see going, if you go to the Naukri Job Speak Index,
Okay.
it's a good measure of white collar employment. वो नीचे जा रहा है, नौकरी का Job Speak Index नीचे जा रहा है. It's easily available on Naukri ka website, naukri.com ka website. Now, all of this in the Western context wouldn't be so alarming, because they have labor scarcity in the West. They have an aged population. We have the youngest population in the world, median age 28, roughly producing 10 million graduates a year. I think it's a very worrisome situation. Right? Such is the nature of free market economies, worrisome situations will develop. But what's making me more perturbed is there doesn't seem to be that much realization
Okay.
that the situation is worrisome. Now, people who are 22, 23-year-olds, they're probably looking for jobs, trying their best. But people in their 30s and 40s who are living in the sort of throes of this technological disruption, I'm not hearing from them a lot of financial planning going on, a lot of thinking going on along the lines of what the discussion we've had over the last 20 minutes. That I'm, say, 40 years old, mid-career professional today. I've got 20 years of working life left. There's a degree of uncertainty associated with this 20 years because of technology-driven disruption. And therefore, I need to think through very carefully my finances over the next 20 years, so that when I hit 60, or my spouse and I hit 60, we can then look forward to 25 years of peaceful retirement rather than having to work till the age of 75. I'm not seeing those discussions to the extent I'm seeing them. The amounts of money that people are saving, and the way people are thinking about investing, and the amount they're spending on holidays, on electronics, on clothes, on cars, seems to me to be out of whack with their very modest savings, right? So middle class debt in India, rather than savings, middle class debt in India, we think, our research suggests, is amongst the highest in the world. So if you leave aside home loans, which ironically, again, home loans in India are a very small part of household debt. If they were higher, I would be happier. But leave aside home loans, ex mortgages, household debt for the Indian middle class is amongst the highest in the world. So it's a deadly combination. Technology-driven disruption in a populous country, young populous country, 10 million graduates a year, rather than saving plenty, net household financial savings as per RBI data is at a 50-year low. And we've got, if you look at the household debt, ex mortgages, it's among the highest in the world. Lots of alarm bells ringing in my head about this, which is why I keep highlighting it. in the hope that people will wake up and do something about it.
And then what next for middle class? Because I think you've also spoken about that salary,
Yeah, I think the
dream
gig, so the gig economy will have to take over, right? So this will happen the world over, but it'll be particularly, what should I say, particularly intense in India. The world over, the gig economy will take over,
Right.
right? So I suspect, so if you look at my, say, writing, right, in my writing career, I write books for one publisher. Various publication houses ask me to write, so I write chota columns for them. Various people ask me to speak, so I speak for them. So my writing and speaking career is a gig career, right? जहाँ पे जो मिलता है, मैं कर लेता हूँ. I suspect for many white collar professionals, the future will be like that.
Okay.
Right? You'll effectively be self-employed, much like lawyers are and accountants are, and financial planners are interested. Financial planners, lawyers, accountants, just like they're self-employed.
Right.
I suspect in the India of 10 years hence, journalists, engineers, coders, bot trainers, right, will also be like that.
Okay.
So the gig economy will become part and parcel. Effectively, all of us will become entrepreneurs.
Okay.
Right? All of us will become entrepreneurs because companies will say that I don't need the same person sitting in my office doing the same repetitive task.
Right.
Anything repetitive will be done by
Got it.
AI, right? Just to think about something as basic as HR,
Yeah.
right? The whole process of getting CVs, organizing interviews, perhaps even conducting the interview, appraising the fellow's interview, making a job offer, negotiating a salary, sending the HR ka letter with the offer. I reckon that's a classic generative AI ka task.
Right.
So at the moment, there are people with stable careers in HR, but because it's a repetitive task, first the IT services companies, then the banks, then the media houses will replace HR with a bot.
Right.
Then they will say, "Yeah, I need trainers from time to time to give presentation skills ka training, leadership training." So HR professionals will have a gig job where they will freelance from company to company, providing whatever is the need of the hour.
Okay.
Right? And that's the world we need to prepare ourselves for. I think that world is 2 to 3 years away. Eric Schmidt last week did an interview, said 5 years hence, no coders will be required. So maybe the world is 5 years away, but I feel 2 to 3 years hence, India will have to readjust fast. My hope is that India readjusts in 2 to 3 years away from this notion of I will graduate and then hunt for a job to a notion of I will graduate and then have to become an entrepreneur. He will have to fend for himself or herself.
Right. And sort of, globally, we are going through this period of tariff uncertainty. So, how do you think? I mean, how are you, also as an investment manager, going to navigate this?
Right? Because I love risks where the risk is bigger. I love risk where the bark is bigger than the bite.
Okay.
Right. So I loved COVID in that regard. The first phase of COVID. Right. I loved it because people panicked so violently in March 2020.
Yeah.
And there were lots of papers saying India में catastrophe हो जाएगा. Western academics wrote papers saying India में catastrophe हो जाएगा. We did a little bit of basic maths which showed us, yes, there will be, in the context of India's long-term history, there'll be a high death rate for the first year or so. But the catastrophic predictions being made for India, to our mind, felt untrue as early as March 2020. So April, May, June 2020, we merrily loaded up on India. And as I said, F21, 50% plus returns in CCP and 90% plus returns in LCP. I get the sense that the Trumpian world is similar. His bark is clearly bigger than his bite because he's making a series of provocative policy interventions, which he's then reversing promptly, and thus setting the stage for negotiations. And basis the announcements made by the American government itself over the last 3 weeks, it's clear that barring China and even with China non-technology products, they're happy to negotiate everything. So even Chinese technology products, the government seems to be negotiating. In fact, Scott Bessent said yesterday that even they're generally happy to negotiate with China. So I think what Trump is doing is a negotiating tactic. Ultimately, the world will settle into a new normal, which will be not dissimilar to the old normal, except that America will make an attempt to take away the kind of Barbie doll type manufacturing away from China back to some place in America. Chinese imports are only 16% of American imports. Chinese non-tech imports are barely 5-6%. On that back of the relatively small share of American imports, Chinese non-tech, 5-6% of American GDP, the S&P is corrected 20%. S&P mid-cap, which is where we do most of our global compounders investment, is available at 25-year lows.
Okay.
So this feels to me to be a classic situation where the risks are exaggerated,
Okay.
both by the person doing the pronouncements and arguably by the media itself. People therefore panic, sell down, and we created 25%, 20-25% drawdown for people like us to put more money into it.
Right. Right. No, and coming back to your financial portfolio, financial planning as such, how much of your contingency fund, for how many months of expenses do you keep aside a contingency fund?
We try to keep 2 years of
Okay.
living expenses in the contingency fund,
Okay, which is in the bank FD.
which is in bank FDs. Yeah. So I mean, there are more creative ways to do it. In fact, most of my colleagues use liquid funds,
Okay.
but I just feel more comfortable with
Okay.
bank FDs. Call me old fashioned. And plus, currently I'm getting a decent rate on my
Okay.
fixed deposits. So So I assume when I budget these things, I assume a 5% return on the FDs. Some years it's a little bit more, some years less, but that's where the FD contingency.
And how about your insurance cover?
So we've got term life cover. We've got a chunky term life policy.
Okay.
We've got term life separate for my wife, separate for me. So we've got term life cover for both of us.
Okay.
And then Marcellus has Mediclaim cover.
Okay.
Marcellus has pretty aggressive Mediclaim cover for all its staff.
Okay.
Plus our parents.
Okay.
So we avail of that.
And yeah, sort of, given the highs and lows we have seen, as an investment manager, on your investments as well, and generally how markets have been over the last 5 years, how do you, have you found any, routine to de-stress yourself? What do you do afterwards?
I do the same thing that I've done for the last decade, which is wake up at 5 o'clock,
Okay.
read the newspapers, have a cup of coffee, a banana, go to the gym.
Okay.
Or it's either gym or yoga, we alternate.
Okay.
And then come to the office at 8 o'clock and do the best that you can in the office. Go home at 7 and have dinner with the family and try to forget about the stresses of the day. Read for an hour, something interesting, something on politics, on economics.
Right.
I'm not able to read fiction for some reason. I'm not able to deal with fiction.
Okay.
Right? Neither am I a big OTT watcher.
Okay.
So read for an hour for politics or economics and fall asleep and wake up the next day and do the best that you can. It's a straightforward job, and I don't think the world in the last 5 years has been unusually volatile. We always believe that COVID hua, Trump hua, right? We keep drawing that, but pretty much every era has its ups and downs.
Right.
And in a way, one of the most interesting aspects of doing this over 5 years with you guys has been, it's when you look back at the 5 years and you realize that there were ups, there were downs, an average pe 18% aa gaya.
Right. Yeah.
Right? If I get really excited in the year where I made 54%, and through I sold my house and invested in the stock market, that would have been a bad idea. And the year where I made -4, I said, damn, equities, let's go to fixed deposits. That would have been a bad idea because the subsequent year I made 20. Right. So that is the nature of equity investing. I think it's also nature of our lives. We go through highs and lows.
Right.
If we can maintain our equanimity, stay calm, do broadly the same thing in a systematic construct, life broadly works out.
Great. Thanks a lot, Saurabh, for joining us today and sharing all those insights.
Thanks, Josh.
Thank you. Thank you, listeners, for watching this episode. For more such interesting content, keep watching Mint.